Have you ever wondered how the current economic situation could affect your investments? Let's explore the economic landscape of 2024. We're standing at a crossroads of economic challenge, a dilemma of inflation and recession. On one hand, we have inflation, a general increase in prices, eroding the purchasing power of your hard-earned dollars. On the flip side, we're facing the possibility of a recession, a significant decline in economic activity, which could mean job losses and business closures. Now, you might be thinking, what does this have to do with my investments? Well, everything. These economic conditions shape the investment landscape. During times of inflation, certain assets like real estate and commodities often shine. In a recession, safer investments like bonds may be more appealing. It's vital for investors to understand this context, to make informed decisions. Now that we have an understanding of the current economic climate, we can delve into the investment process. To invest wisely, you need to grasp the fundamental principles of investment. So what exactly is an investment? In simple terms, an investment is something you acquire with the hope that it will generate income or appreciate in value over time. There are many different types of investments, each with its own potential benefits and risks. Stocks, for instance, represent ownership in a company and offer the potential for high returns, but they also come with the risk of losing your entire investment. Bonds, on the other hand, are a form of lending to a company or government, typically offering more stable returns, but with lower potential for growth. Then there are mutual funds, collections of stocks, bonds, and other investments managed by professionals. These offer a way to diversify your holdings, spreading your risk across a wide range of assets. Diversification, in fact, is a key principle in investing, helping to smooth out the ups and downs of the market. With these basics in mind, you're ready to take the next step in your investment journey. Investing may seem daunting, but it's a straightforward process once you understand it. Let's break it down into easy-to-follow steps. First and foremost, you need to set your financial goals. Are you saving for retirement, a down payment on a house, your child's college fund, or perhaps a dream vacation? Having clear goals will guide your investment decisions and help you decide how much risk you're willing to take. Next, assess your risk tolerance. This is a measure of how much uncertainty you can handle in your investment returns. If the thought of your investments fluctuating in value keeps you up at night, you might have a low risk tolerance and might prefer safer investments like bonds or money market funds. However, if you're comfortable with a bit of a roller coaster ride and you have time to weather the ups and downs, you might have a high risk tolerance and might lean towards stocks or real estate investments. Once you've determined your goals and risk tolerance, you can then choose your investment vehicles. These are the specific investments you make, like stocks, bonds, mutual funds, or real estate. Each of these has its own potential for return and risk, so it's important to choose those that align with your goals and risk tolerance. Lastly, monitor your investment performance. This doesn't mean watching the stock market every day. That's a surefire way to stress yourself out. Instead, check in on your investments periodically, like once a quarter or twice a year, to see if they're performing as you expected. If they're not, it might be time to adjust your strategy. Throughout this process, remember that patience is key. Investing is not a get-rich-quick scheme. It's a long-term strategy that requires discipline and patience. It's about steadily building wealth over time, not making a quick buck. So take your time, do your research, and don't be afraid to ask for help if you need it. And remember, investing is not just about making money quickly, it's about creating a stable financial future. Given the current economic situation, how should you approach investing? Now, that's a question on many minds these days. In the face of economic uncertainty, it's crucial for investors to adapt their strategies accordingly. Staying informed is key. Keep up with the latest news, understand how economic trends are affecting markets, and be aware of potential investment opportunities that may arise. Flexibility is another vital aspect. The economic climate is ever-changing, and sticking to a rigid investment plan might not always be the best course of action. It's important to be open to adjusting your strategies as conditions evolve. And lastly, don't hesitate to seek professional advice if you're unsure. Financial advisors can provide valuable insights tailored to your specific circumstances. Investing wisely during challenging economic times requires careful planning and informed decision-making. But with the right approach, you can navigate your way to financial success. After all, investing isn't just about surviving the storm, it's about learning how to dance in the rain.